S&P and NASDAQ both trying for record closing highs yet again today. Investors debating if the recent run is losing steam or simply ready to push higher. Joining me now is Capital Wealth Planning's Kevin Simpson and PIMCO's Erin Browne. It's good to have you both with us. Erin, Keith Meister sounded pretty constructive on the markets here. What's your view?
I'm constructive as well. I mean, we're in an environment right now where growth is still good. We have inflation coming down. That should be supportive of corporate profit margins. And when we look into the second half of this year, we're expecting to see a little bit of an earnings pickup. To date, this has very much been led by the AI sector and by tech specifically. But I do expect as we move into the second half of the year, we will see a gradual broadening out. That said, I still want to stay long AI and the tech sector, and then incrementally starting adding additional sectors as well, maybe some more cyclical exposure given the underperformance of late.
Kev, I thought Keith's point of view on rate cuts was interesting. The idea if they do cut, it's going to be bad. It's not going to be for the right reasons because inflation's coming down. It's going to be for the wrong reason. And right now they don't need to do anything. The economy is in good standing. What do you make? What do you make of that?
Well, I think the Fed does want to cut rates. I know as the investment community, we would like to see them. But I agree with Keith's point. And what we shouldn't maybe be asking isn't when they cut rates. It should be why they cut rates. So if we look at a situation where they're cutting rates because we went into a recession, that's problematic. They can throw as many rate cuts at us as they want. It's not going to save anything. So this is a very thin needle that they've got to thread. I do think they're going to cut rates one time at the end of this year. But in the longer term, whether it's November, October, December, February, it doesn't really matter. It's affecting short-term trading.
It matters, though, I suspect, in the kinds of stocks that you want to position yourself within, right? He talks about the mega cap names for obvious reasons, because they've done so much better than everybody else, even at a time where you have an investor like that who is looking far beneath the surface, looking for value. But it's no accident why the biggest stocks have done the best. Is that just the way it's going to be until we get even more clarity on the idea and timing of the first cut?
In the short term, absolutely. And to Erin's point, we're looking for breadth in this market. We've been hoping for it for 2 years, especially when you run a diversified portfolio like we do. You can only have a certain amount of money that you can throw to the big tech trade. The rest of the market hasn't been participating in any way, shape, or form. And that's kind of 2 years running now. So I think if we look at rate cuts in 2024, markets will be positive. But if you have the ability to stay in these big names, I would do it.
Erin, you suggest it's time to begin moving into quality cyclicals. What does that mean?
So I think we're starting to see a little bit of nascent signs of a recovery in the manufacturing sector. You saw that earlier today, and you've seen that really on a global basis as well, where you're starting to see manufacturing activity, PMIs globally start to pick up. This, I think, is a healthy sign of a cyclical recovery. We're in early stages, so I think you want to be incremental in this approach, but start stepping into global cyclicals, start stepping into some industrial sectors. The metals and mining sector has gotten, hurt pretty badly over the last month. I think that there's some value there. Similarly in global industrials as well. I think that these sectors are going to start to benefit as we see the rest of the world start to close or narrow the gap with respect to the U.S. The U.S. is still going to be the top of the leaderboard, but you are going to gradually see a narrowing, and that's the time to start to step into those industrial sectors or those more metals and mining oriented sectors that have underperformed.